ultimately, I'll just put a pin on this. Employment comes from growth. Okay? Jobs happen when the economy grows. And right now, outside of AI, it doesn't really look like the economy is growing. And private domestic demand is quite sluggish. So, that's where we're at. It's a very unfortunate situation.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
All right, welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is Friday, August 1st, 2025. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
So how about that before?
So how about this? This is episode 325 of the RenMac Off Script podcast. First one was January 23rd, 2019. So the weekly podcast, that's pretty good.
That's not true. It was well before that.
What?
Yeah, we were doing this in like 2016. We were doing this when one of our former employees, known as Z, was having a bachelor party. And I remember because I slept in the office that night to then get up and do the podcast the next day. And he's been married for well before 2019.
All right, well, leave it.
So just for a reference, for people that don't know, we used to actually have, because we had a lot of athletes in the office, and we had the masseuse tables, right? And we had one because we had a few runners, and we'd have an acupuncturist come in and acupuncture people up. And I pulled it out and I slept on it that day. So it was, it was great.
And did the podcast happen? Good for you.
You could do it face down. You could actually sleep face down without a pillow and be like, nah, whatever. I mean, you might need a bucket underneath it for the drool, but no, it was great. So anyway, just a segue. That's like, we've been doing this almost 10 years.
Okay, so maybe the 325 is not right. I was going to throw in the 25 episodes of the Legend podcast. Remember the series that we did of great investors, which can be found on our website, but that was pretty good too. So
maybe called Legendary.
Next week I'll come back to you for the right number podcast.
That was just very hard to produce because it just required a lot of people and just nobody had the time to do it. But if we have enough, if there's enough interest, if we get enough email on that or whatever, there's comments on it, we can fire that back up.
Those were great. All right, moving on. So let's start with the jobs report today, Neil. Lots going on there.
Well, you mentioned 325 episodes. That's how negative the revisions were almost to this jobs number. So, Governor Christopher Waller has been vindicated. And, look.
So is Neil Dutta.
Well, thank you for that. I pay you to say that. The mark of a good salesperson is to make the client think you're right, even when you're wrong, and even more right when you're right. So thank you, Steve.
You're welcome.
You've earned your paycheck.
My job is
not as many people have, and that's to the detriment of the country. The prime age employment population ratio, this is for those aged 25 to 54, that fell 0.3% in July. That's a pretty big drop in 1 month to 80.4%. That's the lowest since March. I think what's important is that when you kind of smooth out the wiggles and the squiggles, and you take just an average of the last 3 months, prime age employment is down 0.3 against the same 3-month period a year ago. That's highly unusual. I mean, it's historically consistent with the economy being in contraction. And to me, it really just serves as a reminder that the unemployment rate being low and flat against last year isn't necessarily the best summary measure of what's going on in the job market. I briefly hit on revisions, but the revisions to the establishment survey were, unseemly. Okay, the 2-month net payroll revision totaled 258,000, negative 258,000. if you look historically, and we'll have this chart just to our clients, but declines of that magnitude to the data are highly unusual in the history of this data set. And revisions are cyclical, right? So when the underlying trends in the economy are not good, revisions tend to be negative. And when times are good, revisions tend to be positive. Final point, I don't like what I see when I look through the industry detail. So goods producing industries have shed 13,000 payroll jobs in each of the last 3 months. Obviously, goods producing industries are cyclical. So, and you haven't even seen construction employment drop. And given what we're seeing in housing activity, it's probable that that happens soon. And then when you look at the service sector, it's all education and health, sort of like these acyclical industries, not cyclical industries. So outside of private education and health, service sector employment's basically negative, maybe flat over the last 3 months. So it's not really that good. And, look, I mean, it does feel a little bit like deja vu all over again, right? I mean, it's, we kind of thought we were fine last summer, and then we got punched in the face with a bad jobs number. And then the Fed ended up cutting 50, and it feels like we're seeing a little bit of that again. And obviously the bond market's doing what it's doing. You have a 19 basis point drop in the 2-year yield. I mean, Jeff can speak to that. I know that, we were kind of flagging that before. But I do think this kind of opens the window potentially to not just a September cut, but maybe a series of cuts. So September, I believe November, and then December. So you could see that. But that's where I'm at. Ultimately, I'll just put a pin on this. Employment comes from growth. Okay? Jobs happen when the economy grows. And right now, outside of AI, it doesn't really look like the economy is growing. And private domestic demand is quite sluggish. So, that's where we're at. It's a very unfortunate situation.
Is Trump right when he says that Powell's way too late, too slow Powell, or whatever he calls him in the Truth Social?
Well, I mean, I think, look, I think to me, this data it's two things, right? I mean, it's, the fact that the revisions are what they've been, to me, suggests that the momentum in the economy was never as strong as people thought, and the economy that he was handed wasn't as strong as the previous administration had said. I think that's 100% true. But the problem, I think, is that, they've had a bit of a challenge with messaging where they say, like it's the greatest economy ever, it's a golden age. When I think they should have been doing early is just hammer down the fact, like Biden left us a absolutely horrendous economy. He should have just kept saying that. That's why I got elected, to fix Biden's horrendous economy. They didn't really go that route. Maybe they did at times, but generally speaking, they didn't go that route, and that gives them like very little credibility to advocate for cuts. We're here now, and look, I mean, you are going to see this sort of tension with the jobs data getting worse and inflation also probably getting a little worse in certain areas, and so it's going to be, look, I don't think it's like emergency cut. I mean, they are going to cut. And look, I think Trump looks more right now, but I think the part of the issue is a lot of the people that are making this argument, with the exception of Governor Waller, which is why I've said he should be the chair. It's kind of like, I mean, there's a lack of kind of intellectual consistency in the argument.
So when you have two dissents, right, which is I think what that was. Does that help to? Certainly, it helps to catalyze the urgency, but does it give any credence to maybe 50 this time around?
I mean, you could totally see that if you get another dud next month, right? I mean, that's the thing, right? As we know, look, as you know, Jeff, Economic data, unfortunately, I mean, they're not particularly useful to like. You don't call a recession with like backward looking economic data. Like that doesn't happen, right? It's ultimately the data follows. You should be the leading indicator, right? Me or you know what I mean? Like so you
Right.
see what I'm getting at. The only way it really works is like discontinuity, right? Like if you see like a bunch of like 50s or 200,000 on jobs and all of a sudden you get like a zero, like that's what's interesting.
Right.
And so to me, it's like minus 258 on the payroll revision. That's like, is that a discontinuity? So that's kind of where what I'm thinking. So and as we know, like these employment reports, they tend to be like inertial, right? Like, so it's like forecasting the weather. So whatever it was this month is probably a good first pass for what it will be next month. And, like there aren't that many indicators that give you an edge beyond the 3-month moving average of payrolls. Like it's like that's why forecasting it is such a crapshoot. So anyway,
well, I want to get into the sort of the markets, message in a second. But the other big thing that sort of happened this week that we, obviously highlighted last week was the tariff situation. So Steve, why don't you take us on that one, and then we can move to the markets.
Well, sure. I mean, we had a lot of tariff news this week. I guess what I'll focus on right now is just the reciprocal tariffs. We're recording this Friday morning. We got some announcements yesterday on those, and I think a few things jumped out. One is that we're going to have the effective date for these reciprocal rates take effect next week. So, we also sort of mentioned that this idea that negotiations could continue into next week was definitely a possibility. And that's an opportunity. I think you should probably think of the reciprocal rates as sort of a ceiling here. It's an opportunity for other trading partners to negotiate them down. And I think in the case of Switzerland, that was one that seemed to catch a lot of people, including myself, maybe a little by surprise. I think the fact that Trump did take some retribution there with respect to Canada and Brazil, raising their rates. Again, I think there's maybe more of an opportunity for Canada over time to bring that down. And sure there's a joke here with respect to Mexico receiving extension with the Mexican taco. I'm sure that's going somewhere on social media. But decoupling Canada, which saw their rate increase, but not Mexico getting an extension. I think that's important. Earlier in the week, we had reports suggesting that the upcoming August 12th date will be kicked back for 90 days for China. So I think this sort of theme of uncertainty is definitely going to continue at least through next week. But if you're looking for some relative certainty as to, okay, if you think of the reciprocal rates as ceilings that are likely to come down, at least at this point, some companies may be able to start to plan for those. That said, we're recording this Friday morning. We're supposed to get some sectoral tariff announcements today. We saw earlier in the week the announcement on copper. It had been well telegraphed it's going to be 50%. I think what people weren't anticipating was that it was going to apply to outputs rather than inputs. And maybe Jeff can speak to this, but I assume that had something to do with what you saw the price action when those details were unveiled.
Well, Jeff, what says you in particular? So we've got, we've got the Fed who is behind the curve. We've got the tariff situation as an overhang, and you're running right into the worst 3 months from a seasonality standpoint for equities, right? So that's not a great environment.
No, but look, seasonality is icing on the cake, right? That's not enough to make a call. I would say the bigger issue for equities in the last week maybe has been this continued decline in the percentage of issues above the 20-day moving average. So you've got stocks up, the S&P making a new high. I think yesterday it actually made an intraday high on a cap-weighted basis, and the percentage of names above their 20-day moving average, which is a very short-term moving average, by the way, has persistently been contracting after reaching a peak. I think the peak was back either in June or maybe even in May, for that matter, has kind of been slowly rolling since then. So, I mean, that's a divergence. These are neither urgent nor catastrophic, but they just kind of give you a sense as to what's going on. And as I mentioned, I think on the survival guide earlier the week, I was having a conversation with a friend of mine who's like, "Hey, are you still bullish?" I'm like, "Yeah, but this is kind of take your foot off the accelerator bullish, right? This is not keep it nailed down to the floorboards here." And you're seeing it in various areas. You're seeing big gaps up. Neil had a stat that he sent around earlier. It was just so remarkable. It was almost hard to believe. But the move by Meta, the move by Microsoft, the move by Carvana, the move by some of these marquee names and these gaps higher, certainly are good news for the market in terms of the trend. But from a very short-term standpoint, they also belie the fact that people are generally, or were generally, underweight, and so they're using that as an excuse to pile in. And usually, when you get those kinds of gaps at this part of the cycle, they usually consolidate, right? In other words, I don't want to chase many of those gaps. I'd look at those gaps as being an opportunity for people to kind of capitulate and have a FOMO moment, and then that ends up coming back in, and 2 months down the road, they're kind of frustrated and disgusted that they fell for it, and you could buy things at a better price. That's not to say they're tops. It's just to say that it doesn't really play out in the short run as conveniently as what they hope. I think what Steve's getting at is this move that we saw in copper specifically, right? So we had this copper breakout, and we wrote about it when it was happening. Look, copper's in a good trend. This breakout, while it's a legitimate breakout in terms of price, we're more skeptical because it's news induced, and we are historically skeptics of kind of marquee news induced breakouts, because they do create this sort of sucking sound, if you will, and force this behavioral component that just doesn't tend to work out well for people. So particularly given tariffs and the kind of the fickleness, if you will, is probably a fair word, of what we've seen from lines in the sand, and then blurring those lines and crossing them, and then crossing them back over. There was no way we were buying into that copper breakout, and obviously now we've seen, I think it was the worst move in copper in 40 years to the downside earlier this week, and it is getting oversold now. So I think it's interesting. But again, we've talked about this before. The opposite of love is not hate. The opposite of love is apathy, right? And so the opposite of overbought is not necessarily oversold. The opposite of overbought or oversold being good is kind of disdain and disgust. People just don't care. So I'm looking not as much for the oversold condition in copper as I am kind of the people have given up on it and they don't care after the oversold condition. So I think that's going to be a couple weeks down the road. The good news for copper is it's still in an uptrend. That's true with all the metals, and kind of getting this readjustment, I think, is going to be interesting and frankly opportunistic as we look at it into the fall. Historically, and just from a seasonal perspective, we talk about market seasonality a lot. Copper also is at one of its worst points on the calendar. We put that on our Twitter account that you can expect historically. So this all kind of lines up that in 2 weeks, you actually want to be, 2 months, you want to be a buyer of copper. And I would say that's more in line with that apathy and neglect that we'd be looking for.
And Jeff, when you pointed out in the beginning the divergence, right, for the folks that are listening that aren't necessarily as familiar with the language of what we do, percentage of issues making 20-day new highs, if they don't continue to expand as we're making new highs, that's like a yellow flag for you, right?
Yeah, so divergence is simply when the internal structure of the market is doing something different than what you're seeing from the price data, right? So in this instance, what you've got is a new high in the S&P, and the number of names above their 20-day moving average is actually contracting, right? So it says that fewer and fewer names or constituents are driving the market higher. And look, that can happen. It's often a pause, but it just tells, from our standpoint, the way that we think about it is if those are in gear, if those are locked in, then you chase strength. If those are diverging, then you wait for oversold conditions. It's as simple as that. I just gave away a huge trade secret, so we might want to delete that. But that is the way that we think about it in terms of, hey, where do we chase stocks? Where do we take a pause and wait for those consolidations? A lot of that has to do with those divergences.
And then just on that, in terms of the beta and momentum trade, right? So that beta had been, at whatever, the 100th percentile, and that should start to play into that foot off the accelerator, right?
Completely. Yeah, that's exactly. So that's now people say, well, what about momentum? I know. The momentum still is in a much better spot than beta. What you worry about are the high beta names, the high volatility names that have just bounced, right? And they don't really have an underlying trend to them. Those are the names that are dangerous. And so you've got names that are in, chemicals and a lot of the semiconductors. I know that sounds like taboo, but you saw it with Qualcomm the other day. You saw it with Enphase. You're seeing it. Those are the types of names that we're, most concerned about.
Got it. I want to circle back to Powell for just a second. I know we've talked at length on these podcasts about, his seat and how safe it is, but it seemed like the rhetoric got turned up a little bit this week.
I mean, I like stubborn mule more than stubborn moron. If I had to pick, I like. I mean, he's a knucklehead. What was the other one that he used? Um, yeah, Trump has had some great um, nicknames, taunts for Powell. And look, I mean, I've argued that he's not going to fire Jerome Powell. He's just going to be very, very, very noisy about not firing him. And the important thing for the president is to me, it's like if I were advising him, I would say treat this like you would SCOTUS. The way you leave your mark on SCOTUS is by having more of your people in there, right? And, look, the Democrats did this with the Supreme Court, right? Like litmus test, right? Trump has basically followed, I think, he's kind of come out and said it, like, look, I want someone who votes with me. And the way to do this is just to put people in place that can convince other people around them of your position. You're not going to be able to do that by pitching a story about our financing costs are too high, or like something about like sovereign credit risk, like, oh, because we're so strong, that's why our rate should be low. No one at the Fed that's there, especially like Lisa Cook, Philip Jefferson, like these other people that are Biden's appointees, they're not going to be persuaded by those arguments. So you need to put people in there that can kind of at least agree on first principles with the other people at the Fed, and then convince them of, hey, the labor markets suck, therefore we need to cut. And Governor Waller gives you that opportunity, okay? That's why I've been such a strong advocate for him. If Governor Waller is put up there, the likelihood is that Powell leaves. He's playing that very close to the chest. There's an assumption that he's going to leave, but he was asked about it at the meeting this week, and he's like, got nothing for you, mic drop, bye, So if you put in someone that looks politically pliant, someone that basically has a conclusion in mind first and then works back, that's not someone that's going to be able to get the respect of the others at the committee. You may even risk a situation where you're naming a chairman in name only. Like you put someone like a Kevin Hassett up there, everyone looks at him like a toady, and no one respects him, so they all just vote against him, right? Like, so President Trump is talking about how the board needs to assume control from Powell. Well, that's going to be a lot harder if you put in someone that the board doesn't respect, right? So my advice would be put Waller up, okay? And then the likelihood is that Powell leaves in that scenario because Waller's already there. He's already acting like a shadow Fed chair. He's putting out statements about why he dissented this week. Then you get two people to fill the other seats at the Board of Governors because Governor Kugler's gone in January and then Powell's gone in May. And you get two more seats. And you get two more advocates for, a more an approach that, to put it mild, basically overweights the labor market relative to inflation concerns. Okay.
Well, I'd say the best thing that I know we talked about it when Trump was over there with the hard hats, but the best thing I heard was that was like the Mike Dukakis moment back in 1998 with the hard hat on in the in the tank.
I have a question, and I heard this week. Is a toady different than a tosser? So one of my British friends said, "What a tosser," and I'm like, "What is that?"
Yeah, I have heard it. It's funny. It's funny you mentioned that because we're going to London at the end of August for a family vacation, and it's just hysterical. Like it's like Americans will be like, "Can I get a sandwich, please?" And it's like, "Can I have a toasty? Can I have a toasty?"
You have to get ready for the vernacular change for sure.
Anyway, but yeah, I have no idea. I don't speak. I speak American English. Okay.
I looked it up, and it can be used on television. Let's put it that way. So it's okay. But I don't know exactly. I didn't really say what the definition is or where it came from. Unlike I'm going to Canada. being a hoser. And so do you know what it means if you're a hoser? So the hosers from Canada are the guys, the losers from the pond hockey that you had to hose the rink down afterwards. So that's, if you're a hoser, you're the loser who has to take care of the ice after the game.
A hoser. That's pretty good. A tosser, by the way, is an irritating person.
So not a lackey, just an irritating person.
Yeah, just an irritating.
Got it. All right. Well, that applies to 3 of the 4 of us on this podcast.
Wonder which 3 he's talking about. Let's move on to the mailbag. Let's bring in Harry Chen. Hello, Harry.
Hello. So this week we have the question come from John Green, and we are very happy to receive his question. Actually, he mentioned about I'm a huge fan of the show. I have been listening for years. I just want to say your contrarian calls are absolutely master classes. Your insight on China last year and your call after Liberation Day this year are brilliant. So that leads to my question is the healthcare sector the next big contrarian play? Do you see a compelling, systematical upside there right now? Thank you.
All right. So John is a huge fan of the show. That's great. He's been listening for a long time. I wonder if he's been listening since 2016. We'll have to ask him. Right. So he likes the contrarian calls, masterclass. I mean, let's tap the brakes on that. But so the question is, healthcare sector right now, next big contrarian play. So John, more insight from us on how we think about contrarian calls. There's a couple things that happen. I mean, quantifying contrarian is really, really tricky. So that's the first thing I would put out there. It's as much of a quote unquote feel, which I'm not that big a fan of, as it is kind of experiential and then seeing different inputs. So one of the reasons why value tends to work is it also has embedded with it a contrarian aspect of it, right? So you can use value a little bit with the contrarian call and just look for that. And certainly from that standpoint, valuation in healthcare is one of the more attractive in the market. So I would check that box in this case. So valuation, even though it's not officially contrarian, they tend to correlate. So we can check that box. The other is what we call SERM, which stands for Standardized Excess Return Model. And basically what we're measuring is how much return have you had per unit of risk over a discrete period of time in a long time frame. And in this case, it's negative. And so when you run these highly negative risk-adjusted returns, you can't justify owning those, right? So if you're a fund manager who cares about Sharpe ratios, if you're a hedge fund who cares about just risk, there's just no way that you can, just returns. There's no way you can really justify owning these or having these big positions. And our SERM ranking for healthcare is as low as it's ever been. So we've got the data back 60 years. And in other words, if you're a healthcare investor, you've never seen returns on a risk-adjusted basis as bad as what you're getting today. So not only are your returns negative, but the amount of volatility you're taking to get those negative returns is off the charts, right? So that's a setup, and that's contrarian for us. Then we look at things like flows and positioning, and those are actually pretty good. The problem with this call, and this is why we don't just use this in isolation. In fact, we made a very similar call at the end of 2023 saying, look, this is really set up that 24 could be a good year for healthcare because of those factors. And it just never came to roost. So there's, a strike against the good China call, against the good Liberation Day call, et cetera. And that's kind of what happens with those. So what we look for is a confirmation in momentum and a confirmation in trend. And that's not what we've seen yet out of those. So I think you've got good setups. The question is the timing, right? And so what you really want with those setups is something that's more bullish in terms of the price action. And part of that is a reaction to news. And I would just say, looking at earnings this quarter, I mean, some of the biggest misses in terms of, bad outcomes and then bad responses to news have been in the healthcare field. So even those that Our model says, hey, there's a chance that these things beat and they act well. They've beaten and they've acted terribly. So you're not quite there yet from our standpoint that we can just buy them because, but you do have some of those things that are there. But thanks for the question. Thanks for the pat on the back. We appreciate that. And we got a hat coming your way.
You got a hat coming your way.
I mean, since he was so nice, we should give him a chance to actually pick his hat, unlike others who get the black. That's it, black. You can have any color you want as long as it's black.
That's right.
I do have a beat on. I don't know if I'm going to reveal it for you guys, but I have I think a really great idea. It'll probably go over like a pregnant pole vaulter, but I have a really great idea for the 250th anniversary of the country to have a RenMac hat. So I think we're going to have that for next year. So, if you have a really good question, you might want to save it for the kick-ass RenMac 250 year. What was it called? I can't even pronounce it. I don't even know it. It's a huge word. It's not a bicentennial, but it's a quincebice. I don't know whatever. Well, anyway, we'd have great hats for it.
If you didn't know that the 250 year anniversary was coming, I'm sure you're going to hear it from the president.
It's great. If we make it that far, right? It's
Oh, Jesus.
It's a little less than a year away. Who knows?
Well, then maybe that's the segue to Steve Pavlik. What are you watching this week? Anything that's going to make us go away?
Well, I guess a few things. One, we mentioned, the upcoming tariff deadline here for the reciprocal tariffs, I guess, on Thursday. And in addition to that, one thing I don't think is getting as much attention is, President Trump shortened the ceasefire timeline on Russian President Vladimir Putin, saying he's going to impose 100% tariffs on purchasers of Russian imports on Friday. And you're looking at the energy sector, and two of the large purchasers there are China and India. So that's probably maybe good for domestic fossil fuel producers, taking some of that supply potentially online. We'll see whether or not he follows through on that. But that's something I'm watching. I think I'm watching it. We're recording this Friday. Senate's supposed to adjourn today, but it doesn't appear that they're going to. They're still working through a spending bill to try to get a minibus package done before they go. That's important for what it means for the September shutdown scenario. And they're also trying to work through nominations. So there's a chance they may actually stay in a little bit into the first part of next week. So how long they stay in, if they do, is something I'll be keeping an eye on as well.
Neil?
So we have a couple things. I mean, it's, we have ISM services next week. And I'm going to be watching, honestly, jobless claims because, we had the continuing claims data and it got worse for a bit. Now it's stabilized. Now the employment data has come out this morning and it was bad. And it's interesting to see what's going on with claims. Are they still useful in trying to figure out what's going on with the employment report? But other than that, it's a fairly quiet week.
And Jeff?
I mean, isn't today like Christmas for economists, Neil? You've got PMI, you had payrolls.
We didn't have PMI yet. We will have PMI.
I know, but I mean, it's like the day. It's like you wake up and you get the Santa presents, and then you have breakfast, and then you get your parents' presents, and.
I mean, the first week of the month is usually the sort of prime time for the economics data, and then it's the week when you get retail sales and inflation. So, look, I mean, it's the real news is going to be 2 weeks from now when we get CPI data, right? So, we'll see how that goes. But next week it's sort of a bit of a lull in the data calendar.
And Jeff, you're headed up north, right?
I am, and for those who think they're going to come and burglar my house, I've got 4 of my buddies, my friends' buddies, staying here to watch the dogs. So you got to contend with 2 dogs that are fairly good watchdogs, and then 4 knucklehead 21-year-olds with access to a liquor cabinet. So have at it. If you want to take on that challenge, good luck.
People might come over for a party, I think.
Well, that's probably more like it. Did you ever see that Project X movie? That's unbelievable. It's a true story. I have to watch that again. It's unbelievable. Anyway, what am I watching next week? Look, I think the dollar, we've talked about this a little bit. The dollar oversold. I know it's weaker today off of some of this tariff news, whatever. But What we're looking for is a continued rally in the dollar. If for no other reason, John, we're getting back to some contrarian. Just looks like people are a little offsides. A lot of bulls on the yen, a lot of bulls on the euro. A lot of bears in the dollar, very oversold. Some of that momentum has cooled. So it looks like we can have just a tactical rally. I wouldn't look for anything more than that. DXY would be somewhere around 103. So we'll look for that. And then, again, and I hate to beat a dead horse, but we continue to believe that we're going to have this shift away from beta towards momentum. And I think that's going to be the important call, kind of the big picture call between now and the end of the year. So that's what we'll be watching. In terms of levels, the 50-day moving average is right around, let me get that because that is an important level for support. That 50-day, and I don't think we get down there, but just gives you some reference point, is 61.29, basically 61.30 on the downside, which would be about a 4.85% correction from the peak. I think that's kind of pushing your luck, thinking that you're going to get there, but that would be one of the levels of support that we'd be looking for. So.
All right. Well, that's a good place to end it. I'd remind people, go to renmac.com. If you get a chance, you'll see the drop down for the Legends podcast. So most of those Legends podcasts will be on there, not all of them, but most of them. So take a look at that. You can also sign up for a free trial for our work if you're not already a client. Yes.
Including Legends, our friend now, Mr. Treasury Secretary Scott Bessent was on there. Yes,
that's great. It's a fantastic.
Had some great insights, by the way. Really, really. I don't think they should come as a shock, but really insightful insights.
Yes, and done at a time when he wasn't the Treasury Secretary, obviously, and gave a lot of good thoughts. So you can follow us on YouTube. You can follow us on the X or the Twitter or whatever we call that these days. And we will be back next week for episode number XXX. I don't know, but we'll get that squared away.
For off scripted, that sounded pretty damn scripted, I got to tell you.
What, the XXX?
No, your little outro rambling there.
Oh, well, I'm getting better. It's taking
Until next week.
One will be 1 week older and 1 week wiser. I'm Steve Duttonhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
Thanks, everybody. Have a great week.
See you.